Today we'll continue with our discussion of the asset classes. We'll start, as we've been doing, to review prior classes. Hopefully you're writing this down, enhancing your answers, strengthening each time, going deeper and deeper into the understanding and comprehension of what we're talking about here. And then once we do that, we'll continue with our major asset classes. We started stocks last time. We'll finish up the intro to stocks, and then we'll get into beta, capitalization style, and U.S. versus non-U.S. It spells the word bucks, not in the right order, but it spells the word bucks if you move U.S., non-U.S. We might get into alternatives today. We'll see. So reviewing where we've been, define a portfolio. Remember, it's a collection of assets, securities that are held for some future purpose, some future cash outflow. There's 3 questions you ask. Why are you investing? The main focus there is your horizon. You ask, what can you invest in? And there is your list of asset classes. You want to be parsimonious there. How are you going to invest? Are you going to do it yourself or hire someone? Do you have a strategic allocation? Do you try to be tactical and try to beat the markets? Are you active? Are you passive? The major asset classes: cash, bonds, stocks, and alternatives. And then you need to distinguish between cash and bonds because they're both essentially the exact same asset, loaning money to other entities. But cash and bonds are distinguished based on reinvestment risk and price or interest rate risk. So you want that in your answer. You want to talk about cash and cash equivalents. There aren't any sub-asset classes there. And then you get the bonds, DC cuts I. Remember, on DC cuts I, you want to define what it means. So what is duration? It's a measure of the average life of a bond using the cash flows as the weights. It's the weighted average time to maturity. It's a measure of interest rate risk or price risk. You want the subcategories. So with duration, it's short-term, intermediate term, and long-term bonds. And then you want the strategy. You want to talk about, hey, if you expect interest rates to fall, you want to lengthen duration and make sure you use the right terms to lengthen duration. Interest rates expected to rise, you want to shorten duration. So you want to be able to do that on each one of the DC cuts I. Some of them don't have many subcategories. So on convexity, the first C, we said there are bonds that have positive convexity and bonds that have negative convexity. For C, the second C, credit, you have high quality, medium quality, and below investment grade. U.S. versus non-U.S. So since you have U.S. and non-U.S., U.S. you can break up between developed and emerging. T, you have bonds that are taxable, which is most bonds, and you have tax-exempt bonds. On structure, you just have structure. There are no subcategories, but structure is just a special class of bonds that are structured debt. And in I, you have inflation index bonds, which is the rarity. There's not that many of those. And then you have nominal bonds, regular bonds. So make sure on each one you can define it, give the sub asset classes, and then talk about strategy. Let's continue with stocks. Remember last time with stocks, we said the expected return on stocks is a dividend yield on stocks, which right now on the S&P 500 is about 1.7, 1.8%. And then you add expected earnings growth. Historically, dividend yields on stocks have been about 4%. Earnings growth has been about 6%. So stocks have given us a return of about 10%. But going forward, what do we expect? Well, that 6% earnings growth, that comes from, essentially it's tied to economic growth of the U.S. economy. And I showed you a chart last time that showed that our economy actually grows faster than earnings growth. And where does the economic growth come from? Well, productivity, labor growth, and inflation. And we know that 6% earnings growth is a little bit skewed because inflation historically has been closer to 3.5% because of the high inflation in the 70s. So that 6% would probably be more like 4.5% today, given our very low inflation today. We also know that, and I showed you charts last time, employment growth has been much slower recently than it has been historically because we had all the baby boomers coming out of World War II. They started having a bunch of babies. So there was a lot of labor growth. Then in the 60s and 70s, women joined the labor force, and that increased the labor force. But since then, we have baby boomers retiring. We do have the Echo generation, which is the kids of the baby boomers' kids. It's a larger population. It's still not as large as the baby boom, but it is larger. We have seen a little bit of increase, but still, labor growth has not been that high. Labor growth going forward, because of the baby boomers retiring, is going to be very closely tied to immigration. We're going to have to replace workers in the U.S. with workers from outside the U.S. The problem with that is the entire world is seeing a much slower birth rate. Some emerging countries still have a higher birth rate, but even as their wealth increases, their birth rates will fall. So it's going to be a challenge. Labor is going to be a challenge that might be replaced with robotics and artificial intelligence. I know in the last election, there was one Democratic candidate talking about how we needed a universal basic income because AI and computers were going to replace a lot of labor. So there are those debates and that concern. And then the last part, and the most important, is productivity. And I showed you productivity historically in the U.S. has ranged in the 2 to 3% range, although the last few decades we've seen much slower productivity, which is very hard to explain. You think with robotics and artificial intelligence and nanotechnology and all these things, the internet, all these things that are happening, you would think productivity much stronger. I should probably try to one of these days find the article that President Obama submitted to The Economist at the end of his second term, where he said productivity was one of the biggest concerns in the U.S. and how do we fix it? His solution was we've got to work on education. I agree education is the issue. I would probably disagree with him on how to fix education. We've got a UTSA alum who is absolutely at the forefront of education reform, and it's pretty amazing the debates that they're having on education, and it's pretty amazing what COVID-19 has done to the debates on education. But that's going to be a big one. But those are the things that we got to look at. If productivity in the U.S. remains in that 1% range, it's going to have an impact on corporate earnings. Corporate earnings will not be as fast. So productivity is extremely important. Where does productivity come from? Where it comes from innovation, new inventions that make us more productive. It comes from the education system. That to me is probably the most important one, is looking at education. It comes from immigration. We have to have a workforce where we can bring in higher skilled workers from overseas. We know the U.S. education system is not producing the mathematicians and scientists that other countries are, and so immigration is going to be important. In fact, you always need to hear the statistics that half of the businesses that are started in the United States are started by people who were not born here. So not only immigrants have skills, but they also tend to be a little bit more venturesome as far as starting new businesses, and they've been very successful in starting new businesses. I've got a friend here in town from India. He was born in India and spent most of his life in India, came to the United States, and he's already started a few businesses and sold them off. Very successful businessman. And then government regulations, that's a real key as well. We saw during Trump's administration a reduction in regulation, and there's been some debate about how he did it and how well it worked, but there seems to be some consensus that some of the regulation reform that he did certainly had an impact in economic growth in the United States. But you have to look at that and see how do countries compare one country to another. So we can certainly look at some of these things. Cultural things is one thing people do talk about. Are there cultural differences between countries that makes some countries more productive than others? And you hear the debate between United States and other countries, especially some countries in Asia. Japan has had some articles written where business failure is much more negatively viewed in Japan than in the United States. And some people are much less adventuresome, much more leery of starting a new business because business failure is so negatively viewed in that culture. Whereas in the United States, you start a business and you fail, and people say, hey, you gave it a try, businesses fail, So in the United States, business failing is not as big of a deal. In India, they've had some debates the last several years about improving their bankruptcy rules so that failing in a business is not such a horrible thing. So that certainly could be part of the cultural, or maybe it's the regulatory and government side of this. Let's look at a couple of these things and just see what we can say about different countries. On education, the PISA scores have gotten a lot of press. I don't know if you've heard of the PISA scores. I can't remember what PISA stands for, but I'm sure it's in here somewhere. But they compare countries against each other, and obviously you've heard the news that the U.S. does not score very well versus other countries. We've improved on reading. And so here you see the reading score. So China, Singapore, Asia really dominates. Estonia, Canada does really well. You see the Nordic countries doing really, really well. Korea does really well. United States is doing much better on reading. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So 13th on reading. But then you get the mathematics. When you get the mathematics, again, China, Singapore, Asia really dominates. The Nordic countries dominate. And then you get to the United States, and the United States is way down here on mathematics. Pretty sad. And on science, United States does better than on mathematics. I'm kind of surprised the United States does this well on science. My science classes in elementary, middle, and high school were really quite terrible. But U.S. is doing okay, but still well below the top of the list. So this is a PISA score, is a good way to look at different countries. There has been some analysis in the United States that part of it is an incentive problem. They have done some studies that if you actually pay students to take the exam, that U.S. exam scores go up much better than other countries. So if you pay students in China to take the exam, their scores really don't improve much, but you pay U.S. students to do well on the exam and their scores go up quite a bit. So that might be part of the cultural thing. Some countries, education's so emphasized that students just do their best every single time. And the U.S., I don't know how they hand out the PISA exams and how they actually do them in the schools. But somehow in the United States, they're not emphasized, and so the students may not have a strong incentive to do their best. So, but how much that impacts it, who knows? Who knows? You know, there's obviously analysis of the dispersion in the United States. High quality schools versus low quality schools, private schools, chartered schools, public schools, inner city public schools. I volunteered for over a decade in the inner city public school here in San Antonio, and I was just appalled at some of the schools, just how horribly bad they were, and other schools I was really impressed. So even within that same district, they were all in the same district, some schools were quite exceptional, and some schools were just, I really, there was one school I volunteered at that I thought the students would have been better off if they dropped out after middle school, because the teaching was just there was no learning going on. So it's all over the place. And so there may be a wider dispersion in the United States than there are in other countries. There's been several books and articles written about Finland and some of these Scandinavian countries, and a much different basis for their education, no homework, much less stress. Students can do their own pace of learning, and that works really well there versus a Singapore where the reputation is the students are in this incredible stress. These poor kids, they're just school's all they do. They go to school all day. They come home, they have tutors. There's actually laws in some of these countries like China and Singapore where it's illegal to have your children go to a tutor, because these students are just in school early morning to late at night trying to get these exams, but there's so much pressure on the exam. Singapore is a good example. Is you've got to do well in public school and before college, because that defines what college you're going to go to. And then when you get to college, the colleges have very low scores. They don't do well at all. It's almost like the students have spent their whole life studying, and so college is time to party. Whereas in the U.S. colleges still rank very, very high versus the rest of the world. So interesting. This might be an interesting report to read. I've never read through the whole thing. You might be interested. There could obviously be some debate about just how the exams are structured and who teaches to the exams and those type of things. The other thing we talked about was the ease of doing business related to productivity. And so the World Bank has a survey that they do where they give the ease of doing business. And here you see the U.S. ranks pretty well, number 6, not number 1, but number 6. New Zealand ranks very, very high. Singapore, as we mentioned, high. Hong Kong, very, very high. There's a lot of debate about Hong Kong, obviously now with what's going on with China taking over and being much more aggressive than was probably expected when the UK handed Hong Kong over. I've always wanted to go to Hong Kong. Now is probably not the best time too with COVID-19 and with the political uncertainty, but the Hong Kong stock market is doing fine. Denmark, South Korea, and then the US. But what's interesting here is not just where they rank, but what they rank on. So the ease of starting a business, you can see the U.S. does not rank very well there. And a country like Georgia ranks very high there. Dealing with construction permits, the U.S. ranks a little bit better there. I've never had to deal with that. Hong Kong ranks really well. Getting electricity, you can see the United States doesn't rank very well. Hong Kong ranks very well there. Registering property, getting credit, the U.S. ranks very high there. Some countries like Denmark and South Korea more difficult. Protecting minority interests, that's really, really important. Is if you're a 1% owner, 2% owner, you don't want your rights suddenly destroyed. Paying taxes, I'm not sure what's all there, if it's the rate or if it's the type of taxes. Some countries have value-added taxes. U.S. there's sales taxes, income taxes. Trading, the ease of trading. Enforcing contracts, that's extremely important. United States ranks really well there. South Korea ranks there. You can see New Zealand doesn't rank quite as high there. Resolving insolvency, we just talked about the bankruptcy laws in different countries. You can see the U.S. ranks very high there. I don't know who would be number 1 there. You go down the list, you can see some countries like Canada don't rank as high as you might think. Japan doesn't rank very, very high. So you just go down the list. Let's look at in India. So here's India. Let's see how they rank on resolving insolvency. 52nd, not as bad as you might think, but enforcing contracts is very, very weak. You look at a country like Russia. Russia's an interesting one. Russia is a country whose rank has improved quite dramatically, but you have to ask, how did it improve? And what Russia did is they looked at these categories and they found some easy ways to improve them on some of these categories. And there's been a lot of question if they didn't just start playing with the data, playing with the statistics, to get higher ranking on something that really wasn't improving for the business. I do a lot in Costa Rica, and I can tell you Costa Rica is a terrible place to do business. They're ranked 74th. Starting a business absolutely is a problem in Costa Rica. We started a restaurant there, and the regulatory requirements to start a new business are absolutely insane. It's just crazy. Getting credit, I'm surprised that ranks as high as it did. One thing they should put on here is opening a bank account. I remember the 2 people I work with in Costa Rica, they were in the United States, and I wanted them to get a banking account in the United States so I could transfer money to them much more easily. So we went to UTSA about 15 minutes before they were going to close. And the 2 people who were with me, it was like, there's no way, there's not enough time. We can get a checking account. So, yeah, we'll get one. We walk in. It wasn't actually the USA Bank. It was just a branch office. So we actually did the entire thing through a virtual online talking to the rep. They sat us down. They got all the information. We left before 5 o'clock. with checks, with a banking account, with a card in the mail for them to be able to do ATM. It was all set up and ready to go. They were absolutely amazed. They said if you did that in Costa Rica, that would have taken several months. So that's these different countries. They look at how do they improve their economies. Hopefully, this World Bank ease of doing business is reporting the correct things, so that if a country actually improves these things, they will get better and actually truly improve their countries. If you look at the list, Somalia ranks last, Eritrea, Venezuela obviously right now is just a mess. You can see they don't rank well on anything. South Sudan, obviously, Libya, you see countries that are in great turmoil right now, all the way through. And then you get the strongest ones, which is what you would expect. The United States, where do they need improvement? You look at these things and you ask, how can you improve that? How you can get better? I'm really surprised we don't rank higher on some of these things. There have been some discussions about registering property. In my property and casualty class, we talk about title insurance, and that there are some countries have figured out ways to register property in a way that title insurance is not even needed, because the way they make sure that who owns the property, and then any changes to that have to go through a process. And so you have great confidence that the person that is shown as owning the property actually owns the property. But anyway, it's another good report. You might get onto their site. It's just doingbusiness.org. Go on their site and just look and see how they do this. Give yourself some background in this analysis of economies, because it's really critical. It's really critical to you as a stock investor. You're trying to decide which country you want to invest in. You just don't want a country that ranks high on this list. What you're really looking for is a country that's truly improving. So some of these countries down at the bottom may be interesting places to invest, like Iraq. I was listening to a podcast of a gentleman who was doing extremely well investing in Iraq, because he said, yeah, the headlines are terrible, everything is sitting in the news, but when you actually get there on the streets, things are improving. Now, I'm not sure if that's really true the last couple of years. This podcast was a couple of years old, but he was finding really good ways to invest in some smaller businesses that were getting it to work. But you're looking for a country to invest in that's improving on this list. It used to be ranked low. Maybe they were 150th and now they're 120th, something along those lines. You try to figure out, and there could be some regression analysis you could do, which of these rankings are the most important as a stock investor. And so, it's a lot of analysis you could do. I'm sure there are some hedge funds out there that are doing that type of analysis to figure out, where do I want to invest? That's the key. Now, there's more research that you could do on that, and we'll talk about that here, especially on international side, some books you can read. But that's the key for the introduction to stocks. Stocks give you first, stocks are ownership in a firm. You have unlimited upside, limited downside. That's that part of that corporate structure. And stocks expected return is the current dividend yield plus expected earnings growth. Expected earnings growth is directly tied to the growth in economies, and in fact, corporate earnings don't grow quite as fast as economies do. Where does economic growth come from? Productivity, labor growth, inflation. You bring all that together and you've got a really great platform, foundation for discussing stocks. If you get into an interview and anything else, that's it. That's what stocks are. They're fairly straightforward. If earnings grow, you'll make money. If earnings don't grow, you won't make money. Now, we can do the subcategories for stocks. We're going to use this bucks. I won't do it in the order. I'm going to do B, C, S, U in that order. But we'll start with B, which is beta. I'm using the word beta here as a substitute for exposure to the economy. The actual beta from the capital asset pricing model, we'll talk about that in more detail later. You should have already had it, but we'll cover it again. It's one of those things we cover maybe a few too many times, but it is an important concept. But here to beta, what we're talking about with beta here is your exposure to the economy, exposure to recessions versus recoveries. And so here what we're really looking in is what sectors or industries do you want to be in. So the subclasses here, again, you define it. So beta is your exposure to economic events. And the subclasses are cyclical stocks, defensive stocks, and there are some that are maybe in between. But cyclical stocks have high betas. These are the stocks that if we go into a recession, they are going to do very badly. They sell durable goods, they sell more expensive goods. So retail like Nordstrom's would tend to be a cyclical stock. There are some retail like Walmart that are not. So department stores, Walmart, Costco, Family Dollar, they would be on the defensive side. But the higher end retail like Nordstrom's or Tiffany's, those are going to be high cyclical, high beta stocks. Durable goods, cars, heavy equipment, planes, those type of things are going to be high beta. Those type of products that when people are worried about losing their jobs, they are going to purchase less of. Commodities, materials, things like steel, those tend, and lumber, and those tend to be sensitive to the overall economy, tend to be cyclical, especially those tied to construction. Travel and leisure, that kind of falls under the retail. Travel and leisure, airlines, cruise lines, hotels, they tend to do badly in a recession. Consumer discretionary, some of these are consumer discretionary. Nordstrom's, autos, travel and leisure, those are the consumer discretionary. Those things that consumers don't have to have, they don't have to spend money on it. And so when they're worried about their jobs, they're not going to buy a new car if they're worried about losing their job. Defensive stocks, these are low beta. Beta's below 1. Department stores, especially discount stores. And in gas is interesting. We generally, during a recession, will buy about as much gas as we normally do. If we've lost our job, we won't be driving as much. But it tends not to be a high beta industry. However, we saw with COVID-19, with the shutdowns, gasoline prices fell dramatically. Energy firms have just done terribly. So there are some specific industry issues in a certain economy that can affect one industry more than another. So, I used to think of gas as somewhere in the 0.9, 0.95 beta, but this last year, it's just the betas have zoomed out. Food obviously is a defensive stock, grocery stores, and that's part of consumer staples. Walmart, Costco, Family Dollar, Kroger's, those are all consumer staples. Those are things that we buy no matter what the economy is doing. Utilities tends to be a low beta industry. We're very low beta industry. We tend to pay for our utilities, air conditioning, light, water, no matter what the economy is doing. We may use less of it, so it may be negatively impacted, but the key here is not that these industries aren't hurt by recession, but is that they do better than average versus cyclical stocks. Telecommunications has historically been a low beta industry. There's some debate about that going forward, especially now as telecom has gotten more into the entertainment business and cable and those type of things. It's a little more questionable, but they tend to have been thought of as low beta. Healthcare, it kind of ranges. Healthcare, because it's mainly paid for through company provided or employer provided insurance, healthcare does take a little bit of a hit during a recession because people are losing their jobs, and so people can be losing their healthcare. The Affordable Care Act has maybe had some impact on that. Healthcare tends to be something we'll pay for no matter what the economy is doing, mainly because we are not paying for it. The insurance is paying for it, but there can be some impact. So it's not necessarily a low beta, and it probably ranges quite dramatically within healthcare depending on the type of healthcare. There are things generally in between, so like restaurants. Fast food restaurants to me tend to be around 1. A McDonald's is about a 1 beta type of company. Technology has gotten questionable. Technology used to be thought of as a high beta industry, but people are starting to talk about Facebook and Alphabet and Apple is being lower beta, that people would give up utilities before they gave up their smartphone, or at least they would cut back on utilities more before they would cut back on smartphones. So the smartphones and the internet searches, those are things that are becoming more more defensive. They're still probably above one companies, but when it comes to advertising, most people will cut back on traditional advertising before they would cut back on Google or cut back on Facebook. So it depends. You have to look at these over time. There's not an obvious answer on all of them, but you should have some sense of what's a high beta and what's a low beta. So definitely airlines are a high beta, auto manufacturers are high beta companies. Obviously Walmart's, Kroger's, those are low beta. Utilities are low beta. There's some that are obvious. There's some like telecom and technology where there's a little bit of a debate. So I've given you the industries here and my view of the betas. So this might help you with paper 3 when you're trying to discuss the beta for your company. I know some of you in your previous classes, beta was a number you calculated or it was a number that you just looked up. I'm not in that camp, and you'll see when we do paper 3 that beta is a forecast. You've got to determine your beta. Historical betas, regression betas are an input, but they're not the entire input. And I'll show you some examples of why looking up betas on Yahoo Finance can be really, really dangerous. But energy tends to be a lower beta, materials definitely a high beta, industrials definitely a high beta. Communications services, that's where telecom has gone, that's where Facebook and Alphabet are now. They've tended historically to have been telecom low beta, and the tech companies like Facebook and Alphabet were high betas. There's more debate on that now. Consumer discretionary by definition is a high beta. Staples, consumer staples by definition are low beta. Healthcare kind of in that in between. Financials, it varies. Financials have 2008 financials did horribly, but that was a financial crisis, so their beta shot up dramatically. It really depends on the nature of the actual crisis and why the recession happened. Because they do a lot of lending, during recession, banks tend to have higher, especially banks tend to have higher bad debt. Information technology has historically been high beta, but there's some debate now that some of that may be coming lower. Real estate has tended to be a higher beta industry. Real estate and utilities especially tend to be very sensitive to interest rates. Some people view real estate stocks and utilities, especially real estate investment trusts that have to pay high dividends by tax law. Because they're high dividend paying stocks, some people view them as substitutes for bonds. And so when interest rates rise, they tend to fall. Interest rates are an important economic risk that affect financials, real estate, and utilities in a very different way than they affect everything else. And that's why some of these industries can be higher beta when interest rates are an issue and not as high beta in other times. So it just depends on the scenarios. So if you have a recession and interest rates are falling, real estate and utilities can actually fare okay because they tend to be a bond substitute. All right, so there's our definition. A beta is your sensitivity to the economy. Are you defensive? Are you cyclical? And then those are our categories: defensive stocks, cyclical stocks, and then those in-between stocks. And here's the strategy. The strategy has two parts. Some students forget that there's two parts. So the first part of the strategy is your overall allocation to stocks versus bonds. So we talk about an allocation to stocks as a beta investment. And so if you allocate the stocks, you're increasing your beta just because stocks have higher betas than bonds. So one of your decisions is if you're expecting a recession, you want to move out of stocks and into bonds. That's part of the beta discussion. But then within stocks, if you're expecting a recession, then you want to move to lower beta stocks away from higher beta stocks. So if I tell you on the exam that your boss is expecting a recession, you have two things to talk about. One, you want to reduce your overall stock allocation, and then you want to use the words within stocks. Within stocks, you want to reduce your beta. You want to move from high beta cyclical stocks to low beta defensive stocks. So that takes care of beta. Let me just show you how different industries have done the last several years. So let's look at the 1 year and the 10 years are not that different. Energy has just been decimated the last 10 years. We've seen gasoline prices come down. We've seen natural gas prices come down. It's just been a terrible time to be in energy. Now, energy used to be the largest sector you look back up here, energy is one of the smallest sectors. There was a time when energy was the largest sector. Now information tech's the largest. And this looks like, wow, that's a really high number. But you have to realize this communication services, that's where they moved Alphabet and Facebook. If you had Alphabet and Facebook in here, this number would be well above 30%. So information tech, when you combine it with communication services, because communication services before they added the tech companies was only a 2 or 3% industry. So they brought real estate out. Real estate used to be part of financials, but they brought it out. Financials used to be the largest sector. Not that long ago, before the 2008 crisis, financials was the largest sector. But you used to see tech is now the largest sector. But you can look at it from a return standpoint. One of the reasons energy is so small now is that energy stocks have just not done well. This is an average return over time. It's not, they didn't just drop 1.63% over 10 years. They fell 1.63% every year for 10 years on average. And when you accumulate that, that's a huge number. But even bigger is technology, up 20%. If you do 20% and you compound it over 10 years, that's a massive number. And that's the reason tech has gotten so huge. So even with COVID-19, you can see tech has just done amazingly. Now, why materials are doing well, that's a good debate. Gold might be part of that, but there's a lot more to materials than gold. Steel and concrete and other things are in there. So it's hard to say exactly what's going on with materials. Real estate has not done well. Hard to discuss that. Healthcare obviously has done well here recently because of COVID-19. Communication services has done well because that's where Facebook and Alphabet are. Consumer staples has done okay. You can see the consumer stocks have done okay. So sorry I left consumer discretionary out. The last time I looked, they were somewhat in line with consumer staples, not radically different. You would think consumer discretionary would have done really badly because of the airlines and the cruise lines, but longer term, 10 years, they have not done that poorly. So there are the industries. So financials have not done well here the last 3 years. They've been pretty weak. Energy's been very, very weak, and technology has just been the strongest one. So let's continue on to the next one. The C of bucks is capitalization. We break U.S. stocks into large cap, medium cap, small cap, and micro caps. So the definition of capitalization is how large is the company when you use the market value of the company. So large cap, it's maybe bigger than 20 billion. These sizes change over time, and there's some overlap. It just depends on where you are in the market cycle. So 20 billion could be large cap, might be mid cap. Mid cap can range from $1 billion to 25 billion. Small cap can range from 100 million to 2 billion. Micro cap is less than 100 million. And then you have the penny stocks. We're not going to talk about penny stocks in here. Those are essentially companies like JCPenney, like Sears, that are really going out of business. Maybe Macy's a little bit. Macy's may not be there yet, but stocks that are definitely going out of business. The market is pricing them to go out of business, and without an incredible miracle, they're done for. General Motors was a penny stock before they got restructured, and there were people buying the stock, and there was no way you were going to make any money on that stock. That stock was going to zero. But people were trading because it was just volatile. It would jump around 40, 50%. If you got lucky, got in on one day and got out on another day, you could make 40, 50% on penny stocks, knowing that you're eventually going to lose 100%. So if you don't get out in time, you're done for. I know people who trade penny stocks. That's just pure speculation. Now, all of these stocks tend to be highly correlated, so there's not much diversification benefit. So there's more of a risk-return trade-off. Large caps within, and be real careful what I say here. Put this in your notes. Relative low, I'm talking relative to other stocks. Large stocks have a high expected return versus bonds, but they have a relatively lower expected return versus small cap and mid cap. So lower returns, lower growth, lower risk than small cap. Small cap tend to have higher expected returns and higher expected risk. All right, so you've got your subcategories, you've got the definitions. So your tactical move, Small cap tend to be higher beta companies. They tend to be more sensitive to recessions. So if you're expecting a recession, you want to reduce your small cap. So if you're expecting a recession, you want to reduce stocks overall, but within stocks, you want to move from small cap, reduce your small cap, and increase your large cap within stocks. You might actually not change your large cap at all. You might reduce your overall stock allocation by reducing your small cap allocation and keeping your large cap like they are. But within large cap, you move from high beta to low beta. So it's a little more intricate of an answer. You have to bring all those together. But essentially, you want to reduce your risk by moving from high beta small company stocks to low beta large company stocks if you're expecting a recession. Here's how they've done. You can see the COVID sell-off of the last several years. Small cap has had the highest return. Mid cap's been a little bit lower, but boy, they've been all over the place. I saw a chart not too long ago where mid cap was just crushing it. So it just depends. Here are some indices I have, and you can just see they've all been about the same. There's not a radical big difference between the performance of these. Right, the next part is the S, which is style. Some students get the S on bonds, which is structure, mixed up with the S on stocks, which is style. Don't get those mixed up. They're very different things. So style is one of the weaker parts of the exam. Some students just don't discuss it much. This is something you could definitely go out and do an internet search on, growth stocks versus value stocks, and just see what comes up. There are a lot of great podcasts and blogs on this topic, so I encourage you to do some research here. So stocks are classified as either growth stocks or value stocks. So we have two categories, growth and value. So let's define it. Growth stocks are those stocks that either have high expected earnings growth or they may just be overpriced. So growth stock is one that has high price to earnings ratios. And we'll talk about PE ratios later in the class when we talk about relative analysis, relative value analysis. But high PE, these are expensive stocks, or they may not be expensive. They may just be stocks that are doing great, fast growth. So right now, Amazon has a really high PE ratio. Does that mean Amazon is an expensive stock that you should avoid? Or is it because Amazon is a fast-growing company that could make you really high returns? You've got to decide that. So if you're a growth investor, you're just looking for growth in earnings. You don't mind paying extra for these stocks because you think they're going to do great. Value stocks either have low expected earnings growth or they're just cheap. So value stocks are inexpensive stocks, but they're inexpensive for a reason. So could you find a low PE stock that has high expected growth? Maybe, but if you find it, yeah, put all your money into it. You're buying a cheap stock that's going to grow fast, but obviously stock markets are not going to let those stocks sit around. They're going to bid up the price so that they become growth stocks. So it's a little tough to know whether a value stock is a good buy because it's cheap or a bad buy because it's got weak earnings growth. So right now, Macy's is a good example. Macy's is a value stock, a very cheap stock, but Macy's is shutting down stores. It's in malls and it's just not doing well. It's really having trouble competing with Amazon and other online, whereas Nordstrom's has done better there. So do you buy Macy's because it's cheap or avoid it because it's a value stock? Not too long ago, Best Buy was a value stock. Best Buy was trading very cheap, and I remember reading several portfolio managers that were all buying Best Buy stock. They just thought it was way too cheap. Best Buy was doing well. It was restructuring. It was changing its business. And sure enough, that would have been a great stock to buy. It's done extremely well. So it just depends. Growth stocks in 2000, they were definitely overpriced and they crashed 80, 90, some of them, many of them 100%. But this last year, growth stocks have done extremely well. Now, one thing to talk about growth stocks and value stocks, and this is hard to explain because it doesn't seem normal. Growth stocks also do well in weaker economies when interest rates are low. And why is that? Well, because growth stocks tend to be, are not tend to be, they are higher quality companies. There are companies that are much stronger financially. They're doing well, and so when you get a weak economy, they're much more likely to survive. Value stocks tend to be lower quality companies. And I don't have this in the notes, so you need to write this into your notes. Value stocks tend to be lower quality. So Macy's is a lower quality company. They're probably getting downgraded by the rating agencies. If we get a recession, Macy's is probably going out of business. If we get a second recession, another lockdown, and we go into recession, Macy's is probably going out of business. JCPenney, Sears are definitely going out of business. So in weaker economies, value stocks do really, really badly. Value stocks do better in stronger economies. They do better when interest rates are rising. Why do growth stocks not do well when rates are rising? You saw this last year. Anytime you saw interest rates rising, growth stocks underperform value stocks. And the reason for that is a lot of the value of growth stocks are out many, many, many years into the future. They're growing faster. A lot of the value is way out in the future. So when interest rates rise, growth stocks, you're having to discount that very far out into the future valuation with a higher discount rate. That's going to hurt their valuations more than value stocks. So it's a little tedious, tough. So I'll be really impressed if some of y'all can give me a great answer on this when you're discussing growth versus value. It's a little tough. But we've seen this last year. Growth stocks did really well during the COVID recession. So it just depends. Obviously, 2000 we had a recession and growth stocks did not do well, but that was more because of those dot-com growth stocks that just they were the things that were truly weak companies, but the market thought they were strong companies, and so it's not a sure bet. There's a little bit of noise in what I have written here, but this is the general trend. Growth stocks do better in weaker economies when interest rates are low. Value stocks do better in stronger economies when interest rates are rising. So we just know growth stocks have been the place to be here the last several years, but you can see for the first several years, they moved very much together. And really, the entire outperformance of growth stocks has been just really the last few months. It is true they were outperforming going into COVID. They sold off with COVID with value stocks. But you go back to 2019, this is the beginning of 2020. All of the outperformance of growth stocks has been 2020. If you look back longer term, and it's a really, really very, very interesting longer term, value stocks and growth stocks, over the longest term, growth stocks are slightly ahead of value stocks. But 100% of the outperformance of growth stocks has been because of 2020. And so some people are arguing that value stocks are about to have their big comeback. The story before 2020 is value stock is the place to be. Value stocks were materially outperforming growth stocks. You don't see that here because the last several years it's been essentially a tie. But if you go back decades, many decades, I only went back 5 years. If you do the max, it's a much closer tie, and you'll see periods of time when value stocks have materially outperformed growth stocks. So, but there's still a debate that value stocks is the place to be, and I've seen more people moving into value stocks. Now let's get to the U.S. stocks versus non-U.S. stocks. So here it's pretty obvious. There's U.S. stocks where you're buying domestically, and then there's international stocks. So the key here, I would put this into your notes. I think this is important. When you see the word U.S. stocks, that's obviously U.S. stocks. When you see the term international stocks, that's non-U.S. stocks. That's stocks of companies outside the United States. When you see the word global, a global stock portfolio will include both U.S. stocks and international. So the word global is both U.S. and international. The word international is just non-U.S. stocks. So we can break stocks into U.S. stocks and international stocks. International stocks have three categories: developed market stocks, emerging market stocks, and frontier market stocks. And the key here is it comes back to, in the U.S. stocks, we can break them between beta, capitalization, and style. You can do that with these other markets as well. Developed markets are more and more getting broken out by beta, capitalization, and style. But developed markets are the larger, more stable, more developed markets. They have similar returns to the U.S., similar risk to the U.S., but they do offer some diversification because their currencies and economies may not be moving together. And here you notice currencies is actually a good thing. Remember when we did non-U.S. bonds? Currencies are so volatile that they just dominated. You didn't notice the bond piece. All you noticed was the currency piece. But here with non-U.S. stocks, the stocks themselves are very volatile. The currencies are volatile, but the currencies help diversify your portfolio some. So you might buy Japanese stocks not just to get exposure to the Japanese economy, but also the Japanese yen will do well when the U.S. stock market's doing badly. Now, it's a mixed bag of things. Boy, it's really hard to talk about. When the Japanese economy is doing badly, the yen will usually do badly. And so then you're losing money on the Japanese stocks and on the yen. But when the yen weakens, that actually helps Japan because then their exports are cheaper. So the very fact that the yen is selling off is going to actually help Japanese stocks in the long run. So you can actually see a point where both Japanese stocks and the yen are getting weaker, but then the yen gets so weak that Japanese exports are cheap, and that helps bring the Japanese market back up even before the yen recovers. So again, it's not a perfect scenario. You've got to think through the different combinations of things. So there are times where the economy can be doing badly, but the currency doing well. Or there's times when the economy can be doing well and the currency's doing poorly. It can be all different types of combinations. So the currencies tend to give you some diversification. The economies give you some diversification. With the emerging market stocks, these tend to be the faster growing developing markets like China, Brazil. They have high expected returns, but boy, they tend to be very volatile. They have not done well at all last several years. But I've seen a lot of people saying emerging markets is the place to be right now because they have sold off so much. You do get some diversification benefit, not as much as we've gotten in the past because of globalization. And then you have frontier markets. These are the really troubled markets like Venezuela, Argentina, maybe Cuba. I don't know, frontier markets. I'm not sure Cuba and North Korea are in there yet. But these are markets that are just, boy, they're just really, really struggling. They do have a stock market. I don't think Cuba has or North Korea actually have stock markets that you can actually trade. So these are countries that actually have markets. You can actually trade stock in these markets. But they're extremely high risk, high potential return. If you can get the right market at the right time, you can do extremely well. And they do provide excellent diversification because they tend to be very country-specific types of risk. Obviously, COVID-19 has been a disaster for some of these countries, so there are some economic global events that can affect them. I really like the Standard & Poor's discussion on this. I encourage you to read this. I'll put that out there on Blackboard. But they distinguish between developed markets, emerging markets, and frontier markets. Developed markets have to have a large capitalization, greater than $2.5 billion. That's a really small number given that we have trillion-dollar companies in the United States now. Their turnover has to be at least $1 billion. U.S. has $1 billion in a few minutes. Their exchange to developed ratio needs to be at least 5%. That is, their stock market needs to be at least 5% of their economy. I think in the United States, our stock market is 85-90% of our economy. So you have to have all three of those for developed. Additional criteria, market capitalization has to be at least $15 billion. So U.S. is better than that. So frontier markets only have to have 2 of these. So that's not much. That's some of these countries, it's amazing. If they don't meet this, all 3 of these, you think about there's something going on there. Now, China has struggled with the 5%. China's stock market is not that large relative to the overall economy. But I do think China is an emerging country. You need a settlement of T+3 in the U.S. I've done some trades that were T+0. So that means you do the trade and it settles 3 days later. The U.S. has gotten to T+1 and even T+0. So I did a few T+0 trades. The sovereign debt needs to be BB plus or higher. Obviously, the United States, it's AAA or AA plus. Non-currents of hyperinflation. We have not had hyperinflation in the United States. There are countries like Germany that have had hyperinflation. And so, yeah, that's something that you can't be experiencing hyperinflation. And obviously, A country like Venezuela is having hyperinflation right now. No foreign ownership restrictions, that could be an issue for China right now. That doesn't mean it's not emerging. You only have to have 3 of these, but it can be an issue. Freely traded currency, that has been an issue for some countries like China, which is probably less so now. So developed markets have to have all of that. And then your per capita. How big is your economy on a per capita, per person, or per household basis? It needs to be at least 15,000. I think in the United States it's like 40,000 or something. I can't remember our numbers. I think China is getting close to this number now. This has kept China out from developed. I gave a presentation to a group of Chinese business owners, middle management and high management, so not necessarily business owners, but people high up in management. They were visiting the United States, and I showed them this chart. Why isn't China considered a developed stock market yet? And I really think it comes down to this section right here. I think they've gotten there or getting there on a per cap. I don't know exactly where they are, but that tells you the difference between the developed and emerging and frontier. You can definitely invest in emerging markets today. There are very easy funds to invest in that give you that. Frontier, you probably can. There probably are some frontier ETFs, exchange traded funds, we'll talk about a little bit later, where you could do frontier markets. But for the most part, it's tough to invest, especially specifically in a country. So I'm going to stop it there. We'll come back and talk a little bit about international stocks a little bit later, but that's a good place to stop.